Hi everyone, Adrian here, mortgage broker based in Sydney. In this video we're going to be going through a granny flat deal. So anyone in the property space, on the investment space, or you're looking for investment properties and you don't know what to do, here is the exact breakdown on one of my deals and I'm going to run through it for you today. So this is a post that I've done on LinkedIn and it's just gone up this morning. So we're going to break it down. So this was a property I bought in Brisbane. Okay, it was bought as of the end of 2021, just before Christmas, and it was in the Ipswich area in west of Brisbane. Purchase price was $388K, and it was for a property that was 4-bed, 1 bath, and there was no carport down the side, but you could access at least 2, 3, 4 cars on the property, no problems, with a really good driveway down the side. All right, the granny flat cost is $190,000, and it is a 1-bed, 50 square meter granny flat with a little patio on the side as well, which is covered, and it's got quite a few good amenities. And just bear in mind that before 2020, this granny flat would have cost maybe $150 or less. So just so you're aware of the price increases with a lot of the builds at the moment. So when we look at the loan cost, let's assume that you're doing 20% on the total. The loan size is $462,000. Okay, 462K loan size at a 5% rate, because let's be completely honest, rates have never been this high for over 10 to 12 years and most likely will not be staying this high. As you know, subject to not giving financial advice, this is just what my opinion is, that once we start seeing the first rate decrease, hopefully as of the start of next year, that rates will normalize somewhere in the 3 to 4% range. He's hoping, but that's what I think is going to happen, and potentially if we go into a really heavy recession, we could see rate drops actually significantly more than that to save the economy and a lot more printing of money if we really hit a cliff or a wall with the economy and we have to really save it. So that's just my view on rates. So I'm using a very fair 5% rate, I think. And the rents, $410 for the front house and $330 for the back granny flat. So $740 per week times 4 weeks in a month. We're looking at $29.60 per month total. The property maintenance, normally in those kind of areas, is anywhere between 6 to 8%. So I've run it at 7% and it comes in at $207 per month. Additional $5K per year for vacancy insurance, rates, water, pretty much everything. And I think $5,000 is a very fair figure if you average that out over a big portfolio. And I've held these properties for upwards of 2 years now, and I think that that's a very fair figure. So the total, we're $412 positive per month times 12 months in a year, $4,944 per year positive. Now, some of the questions: what if rates drop, which surely they will sometime next year? If I fish around for a 3 to 4%, 3 to 4 year fix, we're printing at over 7 to 10 grand per property plus per year before all other line items. So just be very careful in how we describe that. If I go and buy, 10, 15, 20 properties and I've got a lot of debt and I know that those properties on average are going up 5% per year on average over a 30-year period, then if the rates dropped even further, great. But the bigger you are, the more you want to consolidate and become invincible. So if you can get a 3 or 4 year fix at a very low rate, why wouldn't you take it to consolidate the portfolio, get that equity growth locked in over the next kind of 3 to 4 years, and then also you're so cash positive in that kind of place. If you look at my personal property investments, if I got a 3-year fix on the 8 investment properties with all the granny flats on, I could be over 150 grand positive on a per yearly basis, and I'm not even stopping there. So hopefully over the next 12 months, I'll be buying either another 6 more investment properties with granny flats on the back. If that doesn't work out as far as the lender point of view, I'll be buying, 1 or 2 commercial properties totaling about 3 million. So either way, I'm buying over the next 12 months. And then, yeah, if you apply the same kind of reality to that I'm not locking in, 5, 6, 7 million worth of property. I'm locking in almost, 8, 9, or $10 million worth of property. Then, I'm not a 150k positive. I'm more like 300k positive. Okay, let's go over the next line items. So not even accounting for all the write-offs like the below, even better if you're in the top tax bracket. So line items like loan cost, loan interest, depreciation. And the reason why I bring up the top tax bracket is that if you're in the top tax bracket, and always speak with your accountant, don't believe anything I'm saying. This is a personal story that I'm going through, that if I'm in the top tax bracket, I'm almost getting half of all those costs back on a tax return. Okay, so that's amazing. So imagine if you don't have one property, you got 10 to 20, it just compounds. So let's have a look at the next one. So not even accounting for a minimum 5% equity growth per year averaged over 30 years. Now, we always look at these buyers agents in the city that are talking about average growth rates over 10 years of 7 and 8%. And, they can't look at it over a 30-year period. So I'm using 5%, which is much lower and more conservative. So 578 grand times 5% per year equals 28,900 per year in equity growth from this one. So if you lock in a 3 or a 4 year fix, you're locking in gains on average, 120 to 140 grand. So why wouldn't you be doing that to consolidate your portfolio once you built it up? Okay, that's what I'm doing myself. So not even accounting for the growth straight after the build, I could have sold it straight away for 670 to 700k range, which is circa 100 to 130 grand in equity. The two betters, we're commonly making about 130k plus after the build in equity. Now times this by 10 to 20 properties held, and you start getting a picture on what you could be making long term on these kind of properties. Now, this was a Brizzy property in the Perth market. You were getting another 70 to 90 rent per week in this same example, and it's a 2-bedder granny flat. It's not a 1-bedder. Okay, 2-bedder, 70 square meter. This is how much money with such bread and butter stuff like simple granny flat deals that you can make. Okay, and granny flat costs have risen 20+% since the last 18 months. And this strategy is still working amazingly. Works even better on the 2-bedders. This was a 1-bedder. This would have cost sub 150k easily before the 2020 market. All right, and what I'll do is I'll put a link to my calendar below. If you want these types of deals and guidance with a buyer's agent, me on the finance side, and linking you up with the right accountant that can allow you to structure things properly for the long term so you can buy a lot of property, then book an appointment below and we can talk about it. So hit that like button, hit that subscribe button as well, leave me a comment. And this is just a pure bread and butter deal with a granny flat on the back. It shows you the money that you could be making. Up front, it's positive already, close to 5 grand a year. And then throw in a whole lot of tax offsets and write-offs and things, and you start getting a very good picture on what you could be doing on a per property basis and how it helps you from a tax point of view as well, going into the future. I love these kind of deals. They're so simple. A lot of people love to overcomplicate things. They think that you need to be finding unicorns and things like that, when in reality you just need to buy bread and butter stuff like this. Keep buying, keep buying, keep buying, build up the biggest asset base possible, sit on a 7.5 to say 8.5% rental gross yield, okay, make 5% on average per year on a yearly basis, and that's how you make money long term. You lower the risk, and I can say hand on heart, My wife Maria, she hasn't been stressed through this whole process, and it hasn't impacted our marriage, which is the key thing. You want to get through these kind of things without, taking on too much development risk, or buying properties that are not cash flowing, so you're seeing money come out of your pocket all the time. We don't like that. I want to hold the biggest asset base possible with a lot of debt against it, which is great from an ATO standpoint, and then a lot of rental income against it to offset a lot of the risk. All right, so if you like deals like this, hit that calendar link below and we can have a chat and set you up for the future. All right, have a great day. Bye.